Hello, everyone. Welcome to another Adam Live video. On today's video, I am going to discuss in detail and explain how you can use a Roth IRA to buy a business tax-free. So what I'm going to do is I'm going to start with the basics. What is a Roth IRA? Eligibility, why you want to use a Roth IRA to make investments. Then we're going to get into some of the good stuff, some of the details about the strategies for using a Roth IRA to buy business, what you need to be aware of, what are some of the issues that you want to consider. And then ultimately, I'm going to finish with the ROBS, the Rollover Business Startup, using a Roth 401k and another strategy entrepreneurs could use to invest in a business with a Roth. And then hopefully there's some really good questions that we could discuss together. So let's get started. What is a Roth IRA? So starting all the way back in 1997, Senator Roth from Delaware created the Roth IRA. And essentially the Roth IRA is the flip side of the pre-tax IRA. Pre-tax IRA is an IRA that was created in 1974, most common type of IRA. And it's essentially an IRA that gives the IRA owner a tax deduction for $6,000 or $7,000 if over 50 for 2022 when a contribution to an IRA is made. So that's the first advantage, is you get a tax deduction on a pre-tax IRA. The second advantage is your money grows without tax, and that is known as tax deferral, meaning your money grows and it's not subject to tax. And that's what Albert Einstein coined the wonder of the world: compounded interest, compounded returns. Your money should double every 8 years, assuming an 8% rate of return when it's not subject to tax. So those are the two benefits Congress gave us to incentivize all of us to save for retirement, since we are in a private retirement system. We don't live in Sweden or Finland, where the government is going to be providing for our pensions for the rest of our life. We have Social Security, which who knows in 20 or 30 years if that's going to be around, right? Before 1982, I believe, Social Security was not even taxable. Now it's taxable. So you're losing anywhere from a few percent to 30% of what you're getting from the government. And then who knows in 20 or 30 years what they do, right? They may just clip it, or they may reduce it, or they may only offer it to taxpayers. So there's no guarantee what's going to happen in the future. So it's up to us to save, right? And that's what the main purpose and my passion is, educating people about the U.S. retirement system, right? I'm a tax lawyer. I've worked at big law firms in New York City for 9 years. I have a master's in tax law, okay? The first time I even knew that you can use an IRA to invest in alternative assets, I was a 9th-year tax associate at a major New York law firm, okay? So if I didn't know that you can use an IRA to buy a business or real estate, how in God's green earth will the rest of America know? Okay, it's this hidden secret that for some reason is not taught in high school, it's not taught in college, it's not even taught in law school. There's not specific law classes on the U.S. retirement system, right? I took federal income tax, partnership taxation, I took estate and trust, and then I did a master's tax law at NYU for a whole year and took another 12 or so tax courses. There was not one offered on retirement accounts. So this is the biggest source of savings in our country, $30+ trillion of retirement savings, right? About 12 to 13 trillion in an IRA, and it teaches us about the rules. So that's what I'm doing. And this is all free. You don't have to pay $50,000 to a law school, although maybe the government will give you back your student loan payments, but with me, it's all free. So now you know what a pre-tax IRA is, right? $6,000 or $7,000, you get a tax deduction. Money grows without tax. However, if you pull the money out too quickly, before the age of 59 and a half, you're going to pay tax plus a 10% early distribution penalty. If you pull the money after 59 and a half, you'll pay income tax. On top of that, if you reach the age of 72, you have to take what's called required minimum distributions, or RMDs, which equals approximately 3% of the IRA. Okay, when you pass, the IRA gets passed to your beneficiaries, to spouse. The IRA goes into his or her name, and if it's non-spousal, it goes to the non-spousal beneficiaries. Let's talk about a Roth IRA, which, as I mentioned, is kind of the opposite of the pre-tax. Roth IRA, you do not get a tax deduction where you do in the pre-tax. But, and here's the big but, so long as you're over the age of 59 and a half and the Roth's been open at least 5 years, everything you pull out of the Roth IRA is tax-free. Never pay tax. Okay, so imagine you buy Tesla, you buy Apple stock, you buy real estate, or you buy cryptos or gold at a low value, and then when you hit 59 and a half and the Roth's been open at least 5 years, you can pull it all out as a tax-free distribution. Okay, so that is the play. So this leads me into my discussion why you want to buy a business with a Roth IRA. The main advantage is the ability to shelter all your gains from tax. It's the only legal shelter other than life insurance, I would say, where you can shelter all your gains from tax. Okay, and there's no limitation on what that gain could be. So you can buy a piece of property for $100,000 and you can sell it for $10 million. You can buy shares in a startup for $1,000 and turn it into $500 million. There is no limitation as of today. Okay, so the only requirements is, or are, you're over the age of 59 and a half when you pull the money out, and the Roth IRA is opened at least 5 years. That's it. And then everything you pull out is tax-free. So whether it's stocks, real estate, cryptos, gold, private placements, private business stocks, all tax-free. Okay. Who can make Roth IRA contributions? Well, in 2022, anyone can, whether you're Elon Musk or just a regular Joe making more than $214,000, anyone could make Roth IRA contributions. Why? There's something called a Backdoor Roth IRA, which allows a high income earner, someone that makes more than $214,000 married, followed jointly, $144,000 if you're single. Technically, on its face, you would think you would not be able to make Roth IRA contributions because those are the income limitations for Roth IRAs. But since 2010, there are no conversion limitations for pre-tax to Roth or after-tax to Roth. Hence, someone can just make an after-tax IRA contribution and then immediately convert it to Roth. So if you're Warren Buffett, you make $100 million a year, more than that $214,000, you can put in $7,000 if you're over 50 into an after-tax IRA and immediately convert it to Roth. One thing to note is if you have other pre-tax IRAs hanging out there from previous years, the amount of the after-tax IRA contribution that you can convert to Roth may be limited based off the pro rata formula. So let's say you had an IRA from 2012. Let's say it's worth $5,000 today, and you want to do a backdoor Roth IRA conversion of $5,000. The pro rata formula would be you take the pre-tax 5, the new after-tax 5, you add them together, that's 10. Since the after-tax is 50% or 5 out of 10, 50% of that $5,000 can be converted to Roth, and the remaining $2,500 would stay in after-tax, and you'd have to wait till future years to pull those funds to Roth, or you can just convert everything to Roth, but the amount you convert from pre-tax to Roth is subject to income tax. Okay, so now we know what a Roth IRA is, who can make Roth IRA contributions. We know the benefits, right? The benefits are solely driven by tax-free growth, tax shelter, best legal tax shelter out there. So long as you're over 59 and a half, the Roth's been open at least 5 years, you could shelter all your income and gains from taxation. Okay. How do you get into Roth? You can do contributions, as I mentioned. Even if you are Warren Buffett and make more than $214,000, you can always do that backdoor Roth IRA. Second way to get the Roth is conversions. So you can convert your pre-tax IRA or pre-tax 401k to Roth, but you'll have to pay income tax, ordinary income tax, not capital gains, ordinary income tax on the amount you convert. So if you're converting cash, then obviously the value of the cash is what you pay tax on. If you're converting an in-kind asset like stock or property or cryptos, you're going to convert the fair market value of the asset, not what you paid for it, but what it's worth on the date of conversion. So if you bought a piece of land for 100K, now it's worth 200K, and you want to convert that land to Roth because you think some developer will come to you in the next 20 years and give you 20 million, then you're going to pay tax on the fair market value, the 200. On the flip side, if you bought Bitcoin for 60,000 and now it's worth 22, you're going to pay tax on the 22, not the 60. So this is a very, I think, attractive time to do conversions I actually did a lot of my conversions in the crypto world back in 18. So everything for me is in Roth, but I know a lot of clients have over the last couple months looked to do conversions of their Bitcoin or Ethereum or even stocks. Other than real estate, I think everything's been pretty much down over the last 4 or 5 months. So it's been a very attractive time to do conversions because, again, you're paying ordinary income tax on the fair market value of the asset you're converting, not what you paid for it, but what you're converting. So now let's move into ways to use a Roth IRA to buy business. So there's 2 rules you need to keep in mind. Number 1 is the prohibited transaction rules under 4975. And when it comes to buying a business with a Roth IRA, the code is pretty clear. You cannot, along with a disqualified person, which is essentially you or your lineal descendants, your parents, children, spouse, daughter-in-law, son-in-law, or any entities you control 50% or more, cannot invest retirement account funds like a Roth IRA into an entity, whether it's an LLC or a corp, that is controlled by a disqualified person. So control in the corporate world means 50% or more of the voting power. In the LLC partnership world, it's 50% or more of the ownership. So if you're starting your own bakery, for example, and you're going to own 100%, using a Roth IRA is not an option. Okay, we'll talk about the ROBs in a couple minutes. But in that context, using a Roth IRA is probably not a good option. But if you're investing in a startup with 5 other founders or 20 other founders or 100 other potential founders, then number 1, you got to be under 50%, right? So let's talk about Peter Thiel, right? Everyone wants to talk about Peter Thiel. Back in the late 90s, he used a Roth IRA to invest in PayPal. Right? We know what PayPal is today, but when he founded the company and when he used his Roth IRA to buy shares, number 1, he owned less than 50%. There were a number of founders, including Elon Musk, by the way, but Peter Thiel was the only one that used a Roth IRA. So we know he owned less than 50%. So that's good right away. On his face, it's not prohibited. He only put in about $1,700. So it'd be very hard for the IRS to argue that that $1,700 was a material factor for PayPal's growth. So it'd be very hard to argue self-dealing or conflict of interest because $1,700 didn't really make it or break it for PayPal. If he invested 500 grand or 100 grand, maybe the IRS could argue that, hey, he invested the 100 grand to help his personal interest in that business, and it wasn't done to exclusively benefit the IRA. But in this case, he invested a couple grand. Okay, so that was the first factor. Must be under 50%. Number 2, also, and actually probably more important to the IRS, is valuation. The IRS is focused on valuation when it comes to retirement accounts making investments. Why? Everything's keyed off valuation, especially required minimum distributions. Well, you may be saying, Adam, Roth IRAs don't pay RMDs. You're right. You're right. And that's a factor. And some people suggest that that's the reason Roth IRAs may not be audited to the same degree as pre-tax IRAs, especially if the taxpayer is over the age of 59 and a half, because there's no money to be made unless they can prove prohibited transaction. But if you own less than 50% of a business, on its face, you're not violating 4975 because you're under 50%. So now it's a facts and circumstances test, which is much harder to prove, right? If you heard my previous live video last week where I talked about 87,000 new IRS agents, the IRS has made it clear that for every dollar they spend, they can generate $10 of revenue. So they generally go after very easy targets, low-hanging fruit, okay? That's why the majority of audits involve earned income credit, people that make less than $75,000. Why? Those people generally can't afford CPAs or tax attorneys, and they cave when they get a letter from the IRS and they pay up something, okay? So when it's a facts and circumstances type prohibited transaction, there's facts to uncover. There's discovery, right? Will the taxpayer fight it? It's much harder to win. Now, the IRS could win those cases, but generally the IRS likes slam dunk cases. They don't like any question. Okay, so if there's questions of fact, there's a situation where they have to prove self-dealing, conflict of interest, it's a little bit more difficult to prove, and sometimes they'll shy away from those cases. So that's why it's important to stay under the 50%. Now, going to valuation. You want to show that your Roth IRA is paying fair market value for the shares it acquires. So you want to be able to show that other taxpayers, whether they're IRA investors or non-IRA investors, are paying the same amount at that time for their shares. So at the Peter Thiel example, when he paid 0.001 per share, other investors, other founders who use non-retirement accounts paid the same amount for their shares. So he was able to show, hey, my Roth IRA did not get a special deal that other investors at that time received. Okay, and that's super important. So those are really the only two mechanisms the IRS could use to fight a retirement investment. They could try to argue prohibited transaction under 4975, but if it's under 50%, it's going to be hard, much harder, because you're going to have to show, and the IRS will then have to dispute your facts and circumstances and try to prove that this was a self-dealing conflict of interest and you didn't do this specifically to benefit your IRA, but you made the investment to benefit yourself. That is something that the IRS could prove, but it generally takes more time and effort and more costs. And then valuation, which is really what they focus on. So you want to make sure that when your Roth IRA is buying a business, other investors are at that same point also going to pay the same amount for their shares, whether they use an IRA or not. So I sometimes tell clients, listen, if you're going to own 10, 15% of a private business, so you're under that 50%, let's say you're going to get a deal, you're going to pay $1 a share, try to get other people at that same point, even if they're only spending $100 or $1,000 to buy shares at that same value. Because this way you want to show that your Roth IRA is paying the same value for those shares as other investors at that specific time. Now, clearly, a year later, 2 years later, if the value of the company changes, obviously the share per price, price per share, I should say, would change as well. Okay, so those are the two most important factors. So if you're doing a startup where you're going to own more than 50%, using the Roth IRA is not a good idea, because if you get audited, you're done. You're going to be very, very challenged to fight the IRS, because they'll have the tax code and they'll just be able to show you and you're done. Okay. And then the other thing you want to make sure is you're paying fair market value. If the company raised $12 million 6 months ago, and those investors paid $100 a share, and now your Roth IRA is paying a penny a share, if the IRS looks at those details, it's not going to be easy to overcome, right? Yeah, things change, right? Maybe you lost your biggest client, things happen, but in general, it's going to be more difficult. So it's much easier to have your Roth IRA invest early on at the outset. Ideally, when the company is a shell, right? And there's not a lot of activity. There's no goodwill. There's no inventory. There's no clients. It's just like, hey, there's 10 people investing $1,000. I'm going to own 12%. Maybe half of that 12%, I'll put in a Roth IRA. Why would I want to use a Roth IRA? Remember, once I'm over 59 and a half, the Roth's been open at least 5 years. It's all tax-free. I can pull the money out tax-free. What happens if you're 35? Doesn't matter. If you invest $1,000 and the company later gets sold and that $1,000 turns into $700,000, it goes to your Roth IRA tax-free. Now you can't pull it out and use it personally, but you can still reinvest it in your Roth IRA. You can buy stocks, you can buy cryptos, gold, do another private business investment. As long as you keep it in the Roth IRA world, it's all maintains its tax-free status. So it's super attractive. But it doesn't work for everyone, right? It really works in the case where you're a passive investor under 50% and there's a share offering, whether you're a founder or not, and you believe you're getting a really good deal for the shares. Now, the downside, obviously, the business fails and you lose your money. Okay, that's the same whether you're using a retirement account or not to invest in a private business. Now, what happens if the IRS nails you and they argue prohibited transaction successfully? What can they go after? So, and this is super interesting, actually. And that's why I kind of tell clients in some cases, you really don't have that much to lose, assuming you're not investing that much money. This is why. So Peter Thiel invested $1,700 in PayPal in the late 90s. and he turned that into, I think, $25 million in a Roth. He actually made most of his money on Facebook when he invested $500,000 through his Roth IRA as a very early on investor. I think he may have been the first outside investor of Facebook. I think he turned that into like 500 million. Okay, that was his big score. But the PayPal, he listen, 17 to 20 so million is a good deal. Don't get me wrong. But again, he owned less than 50%, and he was able to show he paid fair value for those shares. Now, let's say the IRS was able to argue prohibited transaction. Generally, it's a 3-year statute of limitation, unless they can show a substantial understatement of income of 20%. And then they can try to push for a 6-year statute. But in his case, he only invested $1,700. So the way the prohibited transaction rules work is if you're deemed to do a prohibited transaction, your IRA is deemed to have been blown up the day you did the transaction. So that means even though Peter Thiel's $1,700 turned to 20 plus million, if the IRS audited him within that 3-year window, all they'd be able to get is $1,700 plus maybe 10% or 15% excise tax. So not a lot of money. So his downside was a couple grand. His upside was unlimited, tax-free. So if you're not going to invest a lot in these startups, and as long as you're under 50%, you don't really have a lot to lose. Now, some people may say, well, I don't care if I own 70%, I'll take my chances. They have 3-year statute. I'm starting my business with $5,000. If they nail me, I'll pay tax and maybe an excise tax on the $5,000. The shares owned by my Roth IRA will become owned by me personally as a capital gain. And whatever, I lost $5,000, but it was worth the risk because if I was able to get through the audit cycle, the statute of limitation cycle of 3 years, bang, they can't touch me. So, I don't suggest that, but, I'm not saying people don't do that. But again, the most important thing is stand under the 50% and the valuation. Now, what happens if you really want to do the Roth the right way and are going to own more than 50% actively? There's something called a ROBS, a Rollover Business Startup Solution, which is really the only legal way you can use retirement money to invest in a business that you are going to be actively involved and own 50%. The ROBS solution takes advantage of an exception to the prohibited transaction rules under 4975D13. So the prohibited transaction rules are found under 4975C. However, any transaction that could satisfy an exemption to the prohibited transaction rules under 4975D are exempted from C, and thus you can do it. So D13 allows for a 401k to purchase what's called qualifying employer securities, basically corporate stock of the adopting employer. So if Ford set up a 401k, the employees of Ford can use their 401k to buy stock in Ford, even though maybe the CEO or some founding member of Ford family is a disqualified person. So basically starting in the late 80s, early 90s, that's what startups did. And I've probably helped, maybe thousands over the year. And I actually wrote a book on turning retirement funds into startup dreams. That's what it's called, on how the ROBS solution works. Now, it's not for everyone. Why? Because you need a corporation. You need to have a 401k. There's procedures. There's policies involved. You need to have a company like IRA Financial administer your plan. You have responsibilities as the plan administrator, trustee, to offer benefits to your employees. Yes, we do help you with that, but there are costs, right? If you do a safe harbor 401k, and you have 5 employees and they each make $50,000, you have to provide each employee about $1,500 as a 3% safe harbor. It's a tax deductible expense, but it's still a cost of the business. Some entrepreneurs do not like corps. They want to use an LLC. And unfortunately, to take advantage of the ROBS solution and use your 401k to invest in a business you're actively involved in that own more than 50%, you need to have a C Corp and you need to have a 401k. LLCs and IRAs don't work. Why? The exception under 4975D13 applies to corps and 401ks, qualifying employer securities. So that is really the only solution. If you want to start a business, whether it's a bakery, a restaurant, whatever, you're going to own more than 50% and you want a retirement account to own it, this is how you do it. You set up a corp. Let's say we call it NewCo. NewCo adopts a 401k. Call it NewCo 401k. Let's say you have $100,000 of pre-tax IRA funds. You roll your pre-tax IRA funds tax-free into the NewCo 401k. Remember, 401k funds at this point, Roth IRA funds cannot be rolled into a 401k. That may change this year under Secure Act 2.0, but unfortunately not at this point. So you have to roll in pre-tax funds. But what people do is then they'll convert those funds to Roth, have the Roth 401k buy the stock in the business, and then you operate your business as usual, as any other company. And at that point, if you sell the business and you sell the stock to a buyer, the 401k, since it's Roth, all the money will go back to the 401k without tax. And then so long as you're over 59 and a half and the Roth's been open at least 5 years, it's all tax-free. Okay, so that is the solution if you want to own more than 50% of a business and want to have a Roth own it. The ROBS is the ultimate solution. But on the flip side, if you're just a passive investor investing in a friend's business or doing a private choice. Now, one other thing to mention is UBIT, unrelated business income tax. Okay, if your Roth IRA is investing in a new business or a business, that's an LLC, not a corp, not a C corp, an LLC, and there's income of more than $1,000, that can trigger a tax known as unrelated business income tax, which gets triggered anytime a retirement account owns a pass-through business, not a pass-through passive activity like rental income or loans or capital gain transactions. But if it invests in a business that generates ordinary income, like selling widgets, that would trigger UBIT only on the use of an LLC, not a C corp. So just be aware of this. If there's a private placement or you're investing in your buddy's bakery or restaurant and it's operated through an LLC and you use a Roth IRA, you can do it if you're under the 50% threshold, but beware of the UBIT tax, which could trigger a 37% tax on income above $15,000 or so allocated to your IRA. So if the Roth IRA owned 20% of the business and there was $1 million of profit and you got $200,000 of income, your Roth IRA would potentially pay about 37% on that $200K. Whereas if that business was a C corp, like Apple or Tesla, then the C corp would pay 21% and any dividends would be sent back to the IRA without tax. So just something to keep in mind. But just to summarize all this, obviously Roth IRAs are super popular. You want to shelter all income and gains from tax. You have to hold the Roth IRA at least 5 years and be over the age of 59 and a half when you take a taxable distribution. If you're going to invest in a private business, make sure you're under 50%. Make sure you're paying fair market value for those shares. If you want to own more than 50%, ROBS, Rollover Business Startup Solution, is really the only option. It involves having a corporation that adopts a 401k, rolling your funds into the 401k. You can then convert them or not. That's your option, your choice. 401k sends the money to the company. Company takes the money, buys the business, the franchise, the assets, and then all the dividends and hopefully the capital gains stock sale goes back to the 401k, whether it's Roth or pre-tax, without tax. And if it's Roth, so long as you're over 59 and a half, the Roth's been open at least 5 years, it's all tax-free. So there's some really interesting strategies for buying a business in a Roth. Now, people ask me, they said, did you start this business in a Roth IRA? And I didn't. I got to be honest. If I had to look back, I would have done it in a second. I should have learned better. And that's my job, is to teach you. Even though I knew the rules, I just didn't do it. And it's funny. There's a story, and it's not just me. My kids had my son had a birthday party before COVID. He had one of these cool game trucks come to the house. It's actually a cool business where it was like 10 kids or so can fit in like a game truck, and they play video games, and it's cool TVs, air conditioning, really nice. Anyways, I was talking to the lady that owned the business. She said she used to be a state official, and she took her 401k, or it was a 403b, and she took a distribution. She was under 59 and a half to buy the business. And I said, well, did you know that you can use your retirement money to buy a business? She said, no, I had no idea. They told me I had to take a taxable distribution, and I took a couple $100,000 out, and I think I paid like 40 or so $1,000 in tax and penalty. I said, well, there's something called a ROBS where you'd set up a corp. She's like, well, I have a corp anyways. The corp adopts a 401k. She's like, well, it wouldn't be a big deal because it's just me and my son. and you would have rolled a 200K into your 401K. 401K would have bought the business. And the beauty of this is you don't pay tax or penalty on the money you're using because it's rolling over into the 401K through the corp, or through the 401K into the corp, and it's all tax-free, penalty-free. She'd be able to run her business, she'd be able to earn a salary, and she would not have had to pay the 40 or so thousand she did in taxes and penalties. So it's not just me. The issue is most people don't realize you can do this. Some people hear about self-directed IRAs, but if you're going to own more than 50%, it's generally not going to be an option. The Roth IRA is a good strategy if you're just doing a passive investment into a private placement, into a growing business. Try to make sure it's a corp. If it's an LLC, you may get hit with the UBIT, but it's just education. That's the key. And that's really my passion. I love educating people, love turning people on to the power of the retirement system. It's really rigged in our favor. It's the one system that the government is literally rigged in our favor. Unfortunately, we just haven't been taught the rules. So if I can help just one person a day, just understand that, hey, even if they don't set up a self-directed IRA with IRA Financial, I don't really care. Go set up an IRA, set up a Roth IRA. Do these three things. Start early if you can, be consistent. Even if you're having a tough year, put $1 in a day. Just be consistent. And then just trust the process. Try not to raid your retirement account. I know things happen. We all lived through 08, 09. We're going through COVID. We went through COVID. We're going through a turbulent economy. I know it's tough sometimes, and I'm not passing judgment. I got you. Been there, but try to limit what you take or do a loan so you can pay your 401k back. Try not to raid your Roth IRA because once 60-day passes, that's it. You can never put the money back, and you may never be able to ever make up for the loss of the savings. So I hope you guys enjoyed today's video. Let me go through some questions that I think may be of interest. Okay, I would like to be a qualified investor making $200K a year to use an IRA to invest in private placements, even if I don't have the account in my IRA accredited. Yeah, to be an accredited investor, you have to have $1 million in net worth, irrespective, not including your primary residence, or make, I think it's $300,000 married, filed jointly, maybe $200,000 single for consecutive years. Although there are deals where you don't need to be accredited. There are friends and family deals, or there's CF, Reg CF, Reg crowdfunding, where if the company's raising less than $5 million, they can open it up to accredited investors. There's even some I think Reg A or Reg Ds, where small percentage of the investors could be non-accredited. So you should ask, are the accredited investor rules fair? I mean, I don't think so. I mean, just because you make $300,000 a year doesn't mean that you're more responsible than someone that doesn't, right? I always give an example. Kid that graduated Harvard Business School, maybe he's making, $150,000 a year, and he's 45 times smarter than the person making $350,000 in terms of analyzing an investment in terms of its risks. So whatever, I think the SEC is trying to protect us. I think their intention is, is something to at least clap over, but I think it's overreaching. I think people should be able to make their own decisions with their money. But again, I'm not in charge of the SEC. The SEC accredited investor rules have become a little bit more flexible over the years because of the Reg CF, the crowdfunding reg, but most private placement deals, whether it's business investments, hedge fund, private equity, venture capital, require you to be an accredited investor. And some require you to be a qualified investor where you need to have net worth of at least $5 million. Next question, off topic. I'm interested in a solo 401k when you're coming and using mega backdoor Roth. You got conflicting steps, so I'm sorry about that. Email me directly, Bergman at IRA Financial, Abergman at IRAFinancial.com, and I'll answer your questions directly. Or you can send an email to info@IRAFinancial.com and just say, for Adam or ask Adam or Adam Live, and it will get to me somehow. But I'll be able to answer your questions. The mega backdoor Roth 401k, I'll answer it right now for everyone. Not all plan documents allow for it. Ours do. And it's essentially a way that you can go dollar for dollar, $61,000 or $67,500 if you're over 50, into an after-tax account in your 401k, and then immediately convert it to Roth. either leave it into the Roth 401k or actually move it to a Roth IRA, even if you're under the age of 59 and a half. So it's actually pretty simple. I'm sorry you're getting conflicting information, but if you email me directly, abergman@irafinancial.com or info@irafinancial.com, you will get to me, and I will happily do a call or email with you to resolve any questions you have. So thank you. I don't have your email, so you can just email me. Otherwise, I think that's it. I don't really have any more questions. If people are watching and down the road at a later time and have questions, you can email me directly at abergman, ABERGMAN @irafinancial.com or at info@irafinancial. You can call us 800-472-1043 if you have questions. And we have some really smart tax professionals in-house, and we want you to call. Our phone number is on our website. We want you to call. Unlike some of these some other companies in the space who won't even put a phone number on their website. Like, we like talking to you guys. We have 80 something employees. Like, we have a really, really good customer service team, compliance team, and we will get you the answer. There's no cost to consult. If we don't know the answer, we'll find it. Okay. We got some really smart people in-house. And if I have to, get dirty and do some research on my own again, I'll do it. I love it. So keep the questions coming. There's a lot of cool stuff on our feed. So definitely subscribe. We post 3 to 4 videos a week. I do a YouTube live every week. I try to at least 12 Eastern Standard Time, Wednesday. I also have 3 podcasts that drop Tuesday, Wednesday, and Thursday. Ad Bits, Adam Talks, and Ad Mail. So don't forget to check those out. And if you're super interested in self-directed retirement topics, alternative assets, current tax rules and events, then keep coming back. Hopefully there's some good information. But other than that, I hope everyone's having a great day. I hope summer's going well. Thanks again for all your support. You guys are really awesome. I really love doing this, and it makes me happy that people are interested and come back and subscribe and want to learn more. Again, this is a private retirement system. The government, don't count on the government being there in 20, 30, 40 years. Okay, we got to do it on our own. But the good news is the system is literally rigged in our favor. Okay, so I've seen it in the last 12 years. I've seen clients literally go from 100 grand to millions. Okay, many millions. Okay. I know how it works. I've seen it in my retirement account, and I'm not even the best investor. Trust me. But I've seen clients that are way smarter than me totally kill it, and all tax-free in a Roth IRA. So there are really, really interesting investments you can do. Again, there's only 3 things you can't do. You can't buy life insurance, can't buy collectibles, and you can't do prohibited transactions under 4975, which is essentially any transaction that directly or indirectly personally benefits you or a disqualified person. Parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. Otherwise, you can do it. And you can have a lot of fun with it. Again, what's private placements, hedge funds, venture capital, private equity, gold, cryptos, real estate funds, flipping, tax liens, tax deeds. There's so much you can do. And best of all, it all goes back to retirement without tax. So thanks again for spending some time with me today. Really appreciate it. Have a great day, and take care.